In this section, we are going to deal with Apple options on the Thinkorswim platform. And you can see it's actually a live market right now, and Apple is down about $1.75. You can see the price is moving. And we're going to look at how put options are structured on the trading platform. Now, put options are a little different. It's a little bit more difficult to understand the layout of the put options. So just like we did in call options, we are going to look at all the different expiries. And, let's pick one. We can pick the March, which has 30 days for expiry. And Apple's current price is 465. So it's closest to 465. So the 465 strike price is going to be the at the money option. And if you recall the call options course, we saw that anything that is shaded gray was in the money. I'm going to expand this a little bit. Anything that is shaded gray was in the money, and anything that was shaded in black was out of the money. And so now we are going to look at the put options, which is on the right side of the screen. So today you can see that Apple has gone down by about $1.69, and the put option that is closest to the strike price is going to be the at the money put option. Now, in the case of put options, the layout is going to be exactly reversed. So the gray area, which is on the top left on the call side, is going to be the gray area on the bottom right on the put side. And the black area is going to be the top right when it comes to the puts, and the black area is the bottom left when it comes to the calls. And that's because, if you recall, we said all the in the money options were on the top left. In the case of the puts, the in the money options are going to be in the bottom right. That's because Apple is already below these strike prices. So if you look at the 495, the 485, or the 480, Apple is already below these. So these put options are already in the money. And the put options that are out of the money, I'm just going to increase the strikes here. And the put options that are out of the money are on the top right side when it comes to the puts. So just like in call options, if an option is in the money, it's going to have intrinsic value. And that's why you see all these options are much higher priced. And because it's a live market, you can see the prices moving. For example, this option has increased by 12 cents. This option has increased by $1.10 today. And it has increased in value because Apple is going down. So as the stock goes down, put options are going to increase in value, and call options will decrease in value. So you can see that on the call options, the net change is all red today. That's because when a stock goes down, call options will decrease in value and put options will increase in value. So all of these put options you can see have increased in value. There are some options that you'll see in red. That's because they've not been traded, and we don't have a price for today. But in general, you're going to see that the layout on the put side is opposite. So the way to think about it, and it's a little difficult to conceptualize if you're a newcomer to options. In the case of call options, the stock had to move towards an out of the money strike price. In the case of put options, the stock will have to move down to reach an out of the money put option. So let's compare. I think we took the example of the 425 call. So the 425 call is in the money, and you can see that the price is $44.86. Now the 425 put is going to be out of the money, and you can see the cost of that option is about $2.80. Similarly, the at the money options, you may not find a whole lot of difference. So if you compare the at the money call and the at the money put, they are somewhat similar. And there's a slight difference between the two because technically 465 call is in the money and 465 put is out of the money. That's because the stock is trading at 465.96. And that's why you see that small difference there. But let's look at the 510 call because that's what we looked at. And this was going, in the call example case, it was going for about $3.90, but now it's decreased by 65 cents today because Apple has gone down. But the 510 call is out of the money. However, the 510 put is going to be in the money. And that's why you'll see the price of this option also is much higher than the out of the money or the at the money options. The at the money options here are going for about $15. The out of the money, the in the money options are going for about $46, and the out of the money options at the 425 are going for about $2.80. So to visualize this, the best way to do this would be if you're buying a call options, you're going to have to think of how the stock price will move up towards the strike prices. So look at the strike prices. That's the best way to visualize this. If you had a 490 call, then you want the stock to go up. But if you had the 425 put, you want the stock to go down. And as the stock is going down, these put options are going to increase in value. So you look at it a few times and you'll start understanding this layout. And there's really no other way to present this kind of a layout. It's a complicated layout. There's a lot of information here, but really it's the only way you can represent it on a trading platform. Now, different trading platforms may have different layouts. I've seen some other layouts where things are horizontal, but it really doesn't provide you with a good understanding of how you can visualize these options. The layout that thinkorswim has, I think, is the best. And even though it might be a little bit of a challenge trying to grasp this layout, it really is the best method to show calls and puts at the same time on a single screen. So this is as far as the layout is concerned. In the next lecture, we're going to tackle all the in the money, at the money. We're going to look at specific options, look at their risk profiles and their profit and loss graphs. Thank you.